Hi, this is Roger Conrad. I'm editor of Canadian Edge. Right now, what I want to talk to you about is these some things that have occurred in between earnings seasons. Obviously, we had our earnings season come much faster for the first quarter than it did for the fourth quarter when we actually got our last portfolio results on the next to last day of the quarter. But this time around, they were all out pretty much in the second week of May, and so now attention is turned to what can we expect for the second quarter. And you know, there are bits and pieces here. You really have to take a look at the overall numbers to get a true picture. So when they come out is when we're going to really get the real idea of what happened. But there are some indications out so far, and I think pretty positive ones so far. We've seen natural gas prices, number one. We've seen natural gas prices now climb back above $5 per thousand cubic feet or a million BTU. Depending on what measurement you use. So that's quite a recovery from the $4 level and even the sub $4 level that we saw earlier in the quarter. How's that going to help producer companies? Probably not a whole lot this quarter because, again, a lot of the sales were made earlier on, but they do a lot of hedging, and the recovery in gas prices is going to help them down the road with contracts down the road, and a lot of companies were able to lock in pretty solid results. And we've seen, of course, Paramount Energy Trust does come out and tell us every time they pay a dividend how they stand in terms of their hedging, and that seems very encouraging. This is, of course, our most aggressive natural gas play. They're 100% natural gas. They have a lot more debt than anybody else, and they've been able to reduce risk primarily by their skill at hedging their forward sales. So very good signs on that one. And if we take a look at that and extrapolate it to some of our safer gas plays like Peyto Energy, which has some of the lowest costs of any production company, and also some of the longest reserve life of any company, over 20 years proven reserves. You've got some fairly bullish signs shaping up. So not sure if we'll see a real blast off in terms of earnings in the second quarter, but it's positive going forward. And with a company like Peyto, which hasn't really declared its intentions after it converts to a corporation, their future dividend is going to be very much dependent on what happens with gas prices. So very positive in that regard, things moving in the right direction there. They're able to maybe lock in some sales at profitable prices, lock in some cash flow, and be able to pay a little bit better going down the road. A few other companies that announced some positive news, and again, you'll read about those. We're kind of in between issues right now, but you'll read about those in the upcoming Canadian Edge, and that's one would be Ark Energy. Made a very nice acquisition. We actually reported on this in a Maple Leaf memo this week. And in a very meaningful way. They're making they made a very nice acquisition. This company has been tilting its production more towards liquids, which is the price of oil, natural gas liquids has been a lot stronger than the price of natural gas, so that's going to help them, I think, in a very big way. And also, they've been very good with some of their finds and with increasing production. So they've got a rising production profile. All these things are positive for their dividend after they convert. They've already told us they're going to convert to corporation at the end of this year. What they can pay as a dividend, though, is going to depend very heavily on gas prices, on what their production is, what their costs are. And all three of these things, I think, in the second quarter we'll see have been moving in a positive direction. Turning to some of our infrastructure-based companies, Pembina Pipeline Income Fund announced that they will be converting to a corporation. They've given us a date of October 6th. This company has decided to maintain its same distribution after converting. They've told us that for a number of months, so that's not a real big surprise. What will help investors, though, particularly if you have this thing in an IRA, is that when they convert to a corporation, the dividends after that date will no longer be withheld at the 15% rate at the border. They're going to be paying corporate tax at that point, and so therefore you will not have that surcharge coming off. So that's a positive. All the dividends up through October, though, will be withheld, unfortunately. So but again, a nice little boost to the effective dividend for those that hold in an IRA after October 6th as they convert. Keyera Facilities Income Fund, another nice acquisition. Again, this has been of some assets, processing assets in their core region. Again, this has been their ticket to growth. They add assets at good prices. They're able to make those accretive to their cash flow going forward, leverage off some of the assets they already have. And again, this is the fuel that keeps that cash flow rising. I don't expect to see a dividend change or an increase until they do convert to a corporation, which they've told us will be I think the end of this year. But at that point, again, adding business, adding cash flow will add to the bottom line. And that being a distribution going forward. So a very positive situation, and they're doing the kinds of things, most importantly, they're doing the kinds of things that are going to keep them growing. Financing is another big issue for corporations around the world. A lot of people are very worried about whether the European, maybe not so much now as in the past, or in the last few weeks, but whether the European sovereign debt worries are going to translate into some kind of contagion and really bring down the house on the credit market, freeze things up as happened in 2008. Well, the fact that Yellow Pages Income Fund is able to continue doing financing at low rates, this case was a convertible issue this week, is a very good sign that they can continue to access credit markets at good rates. And that means, of course, good cash flows, and they'll be able to continue with their growth plan going forward. They've already told us also they're going to convert to a corporation at the end of this year. They've also announced their dividend will be slightly lowered at that point. But after that, I think, again, executing on their business plan, as we see the Canadian economy coming on, more advertising sales, that'll be good for their earnings. So again, these are all sort of straws in the winds. We're going, as you know, we look very carefully at the earnings when they come out. But these are some things that are happening. Give us some pretty good indications that the numbers are going to come out well in the second quarter. And again, that's what we're looking for: strong businesses and verification in the numbers that these businesses remain strong. Thanks for tuning in. We'll look forward to chatting with you next time. And again, the next issue of Canadian Edge will be coming out in early July. Thanks for tuning in.